Okay, welcome everyone to 4.3, the conclusion of chapter 4, where we're learning about mergers and acquisitions. We have what?
Do we get pizza next week?
I mean, we do get pizza next week, but only one slice for you, David. You're cutting, right? Okay, so remember, investment banking is a service that investment banks provide. Investment banks are financial behemoths. They want to make as much profit as possible. So they don't only do investment banking, they'll do things like sales and trading, brokerage services, asset management, and so on. We talked all about that in chapter 1. What's important to note now is how investment banking has tied into all of this. So we know investment banking is a service provided by investment banks, and usually what's compiled within that service is capital markets. Remember, how are we raising money for companies? Are we doing it via equity, like initial public offerings? Are we doing it via debt, like with bonds? That's what we talked about in chapter 3. Chapter 4, mergers and acquisitions, which is another big part of investment banking. And then chapter 5 is leverage buyouts and private equity. And investment banks are pretty important in that process because when a private equity firm wants to exit on that investment, well, they need an investment bank to help IPO the company, do some M&A. We'll learn about that in chapter 5 later on. Really interesting. And note that private equity and mergers and acquisitions are some of the most profitable transactions in the world. That's why I talk about them, because if you enter into them, I promise you'll be a billionaire. But don't hold me to that promise. So 4.1, we learned about the types of mergers, reasons companies merge, etc. So mergers versus acquisitions. Can anyone detail what the difference between the two is? A merger and an acquisition.
So, an acquisition is a bigger company buying a smaller company, and like they're still separate. But mergers is like they become one.
That's my curriculum associate right there. There we go. Synergy. Remember, 1 + 1 = 3. The individual value of things are not greater than what it is combined. So it's kind of weird. Defies math, but that's what synergy is. Horizontal mergers, vertical mergers, and conglomerate mergers. 1 second read. Remember, horizontal, 2 similar companies of the same industry. Vertical, usually like supply chain. Let's say a car dealership merging with the door manufacturer for their cars. Conglomerate, 2 unrelated companies, usually merged due to diversification, decreasing risk. And we talked about the reasons companies merge, whether it be geographic regions, they don't want to organically grow some arm of their company and so on. What's up, Reed?
I'm not going to be here for IBC social.
That's okay, we'll talk about that later. That is so depressing. That is so sad. How could you? Jason, where's your shirt? Jason, where's your shirt? Go put your shirt on. Find a shirt. Wear your shirt. IBC social. Well, remember, we always meet on Tuesdays. So IBC socials are on Tuesdays. It's going to be next Tuesday. Remember, we only have 3 subunits for every unit. 4.1, 4.2, 4.3. Then IBC social 4, 3.1, 3.2, 3.3, and IBC social 3, and so on. In 4.2, we learned about acquisition profiles. So let's say a company wants to be bought, or let's say a company is looking to buy another company. They need to develop an acquisition profile, meaning, what am I looking for in another company? Do I want a lot of debt capacity? Do I want unused tax credits? Is this product going to benefit my product? Are there a lot of synergies here? That's basically that. Hostile mergers. If you guys saw the reel I posted on Instagram, I talked about horse donkeys, and then I talked about bears that eat reindeers. There we go. That is hostile mergers, right? The bear is going to eat the reindeer, whereas a friendly merger, one that's consensual, although we're not going to, globalize that term, one that's consensual is going to be a horse donkey, right? They're both happy together, and they're kind of a mix. We talked about Warren Buffett's acquisition profile. Remember, he has Berkshire Hathaway. Berkshire Hathaway is a conglomerate, has a lot of subsidiaries and so on. Board of directors versus the management of a company. This is important because the board of directors need to approve a merger for it to happen. So hostile mergers only occur when the board of directors do not approve this. And whose opinions are the board of directors responsible for upholding?
The shareholders.
Shareholders. There we go. That's why they're so important, because shareholders are all that matter. And because of that, it's also pretty common for you to see management having large stakes within the company so that they make decisions that are in the best interest of shareholders. Friendly mergers, we talked about that. Now it's time for the real meat. Now it's time for 4.3, what we've been waiting so anxiously for. So the roles of the buy and sell side M&A advisor and the reasons M&A deals may go wrong. Let's just head straight into it. Can anyone detail me the difference between the buy and the sell side? This is a hard question because I talked about it from a macro lens, from a micro lens within an actual investment bank, and now we're going to talk about it in terms of mergers and acquisitions. So give me one of them. Give me whatever you know. What's up, Reed? Buy versus sell side.
Oh, buy side.
Whoa.
That's all right.
Okay, this isn't Wolf of Wall Street yet, all right? We can't use that language. What's up?
Buy side analysts will do research on companies and sell it, or not sell it. They'll just give it out.
They'll buy it. Buy side is buy.
Oh.
One second, what were you saying?
Buy side advisors like advise what to buy. They like look at how the stocks be moving.
Yeah, that's one really big part. And then sell side, in that macro lens,
Sell side is like when to sell. I don't know what it is.
they want to sell certain things that the buy side will buy. So let's talk about the macro lens really quick. Macro lens is sell side, and when I'm talking about the macro lens, I'm talking about how is finance divided. Well, finance is divided by the buy and the sell side. The buy side is comprised of institutions like private equity firms, hedge funds, mutual funds, and so on. If you can't remember what that is, go back to chapter 1, right? It's on the website, wherever you want to look at it. But the key thing here is that the buy side buys, okay, and the sell side will sell. Sell side are investment banks. They're, for example, in initial public offerings, investment banks are selling pieces of stock to institutions on the buy side we generally call institutional investors. So they'll be selling pieces of stock to mutual funds, hedge funds, private equity firms, and so on. So that's the key difference here. Right now we're going to talk about the buy and sell side in terms of mergers and acquisitions. We also have one more buy and sell side, and that's the micro lens. When we look at an investment bank as a whole, sometimes they'll have a miniature buy and sell side even though they're a sell side institution. So investment banking as a service lies on the sell side. However, investment banks, because they're profit-making behemoths, like I mentioned earlier, might have things like asset management, brokerage services, and so on. And some of those things will fall onto the buy side. So it's important to note that. But right now, we're going to talk about how investment banks can function on the buy and sell side in a mergers and acquisitions deal. Meaning, there's going to be a company that wants to buy another company, and there's going to be another company that's going to be sold to that buyer. And investment banks will be on either side and will help advise within that financial transaction. Okay, can you guys just scan this really quick? Again, I don't chastise, I don't really do anything with it. It just, if I ever do need it, count shirts, whatever.
Oh yeah.
Come on, Aaron. And remember, you're doing Williams today, so it's only 2 days. Yeah.
Oh, is that the thing? He's skinning back my favorite.
And point me out. Point me out when your slide comes, because I'm going to forget. Okay, so you have to say you as well. Just point me out. Let me know. And next week during IBC Social, I'm going to have you guys take a survey over finance and board games. It's short. My friend really wanted your advice, opinion on it. Again, this is the website I just showed you guys where I upload all the curriculum, notes, etc. We're starting a new chapter in India and a new chapter in Canada, I believe. So yeah, great news in the past 2 weeks.
We have another chapter and another one in Canada.
Yep. Okay. So, buy and sell side M&A advisors. So again, this is why I talked so much about the difference between the buy and the sell side, right? That's the key important thing to understand here. So the opposite sides of any M&A deal, the buy and the sell side, are worked on by two different investment banking organizations. Throughout the deal, they serve as representatives of each party and work to ensure that a fair deal is reached. Well, the buy side M&A advisor are the investment banks that are on the side of, well, the buyer, the person that's looking for a company. And the sell side M&A advisor is the investment bank that's working with, well, the company that's selling itself to an actual buyer. So something to notice, that M&A business generates a lot of income for investment banks. That's why I talk about it so much, and that's why I care so much about this aspect of finance, not only because of investment banking's exit opportunities, but because of the profitable transactions that they are a part of. Even with identical information present, facts and data, investment banking teams can draw different conclusions. Remember, we talked about fundamental analysis. Does anyone remember what the word fundamental analysis means?
Looking at the financials.
In what way?
Fundamentally.
Fundamentally, exactly. You can kind of think of it like that because you have to look at not only the hard-coded facts and details, but macro trends, micro trends, and so on. And although that's only for a stock, you can kind of apply it here. When I'm looking at a company, I may gauge different synergies. I may look at industries different, and so on, right? There are small areas that are gray of subjectivity that can allow different conclusions to be drawn. So it's important to note that.
So like Ion said, one of the main roles of the buy side is to assist companies in their M&A. So during this, they do a few different things. So the investment bank will help identify possible acquisition targets. They'll perform due diligence, which this is just making sure everything goes smoothly and is legal. Valuing the company, they'll help decide how much the company is worth. Negotiating the terms of the deal with the target firm, and they'll ultimately just help you complete the deal.
Agreed. So remember, this is what the buy-side M&A advisor is doing, meaning, well, the investment bank that's partnering up with the company that's looking to buy another company. These are all of the tasks that he's going to perform, and very shortly, we're going to talk about what the sell-side M&A advisor, aka the investment bank on the sell side, with the company that's trying to sell itself. Interesting stuff, of course. So identifying possible acquisition targets. Investment banks will reach out to possible target firms to be acquired that meet their clients' criteria. Again, what do we develop when we're looking to acquire another company? Does anyone remember? What do we develop? I mentioned it very recently, but it's called a profile of some sort. It's an No. So, okay, let me put this in context, right? Let's say I want to buy another company. There's a certain profile that I make for myself so that I can identify what companies best suit my needs. This is called an profile. I'm helping you guys for the game next week. Acquisition profile, there we go. That's the money question right there. So investment banks they're going to help develop that acquisition profile for their client, right? So they know what the client wants, right? They will gauge the interest of the target firm on being acquired as well, and they're going to discuss the possible transaction with the target firm. So again, we're usually talking about something that's non-hostile here, or this could be how a hostile transaction starts. The other company doesn't want to do it, and then we talked all about our shark repellents, poison puts, poison pills, golden parachutes, whatever. So the disclaimer, M&A courting is very confidential. We're going to get to why in a second. If it became known to the public that a firm was attempting to acquire another publicly traded firm, well, they're going to make the people in the market are going to bid up the value of the target firm, those individual shares. Does this sound similar to something we've learned about? It was in 4.2. It does, right? It's kind of clicking. Remember the bid wars that occurred with tender offers? Well, and a tender offer is a means by which a company can hostilely acquire another company. That's what happens. Sometimes when a company goes through a tender offer and other companies know about it, they're going to bid up the price of the stock. And right here, what we're talking about is kind of a bid war, or at least it's just someone trying to make it someone else's life difficult. So this makes the target shares more expensive to acquire, of course. Great for the shareholders, not so great for the person that's buying it. And we're going to get to that in a second when we talk about the winner's curse. Note, when it's known to public markets that a specific firm may be the target of an acquisition, similar firms in the same industry may also see their stock prices go up. Why? This is because they may become the next acquisition target. So pay attention to your industry, my friend. And remember, industry reports are some of the biggest work. This is unrelated, by the way, so don't let it confuse you. Industry reports are some of the best and biggest works produced by, I believe, sell-side analysts. We learned that, I think, in 2.3. So, I mean, that should just adhere to the importance of the industry, right? Remind you how important it can be. Performing due diligence. What does due diligence mean? 1 second. What does due diligence mean? And I want, kind of, is anything, that's a part of research, but do you guys have a really general good definition of due diligence? I'm looking for the one that I said a very long time ago. Analyzing financial details or details in general prior to a transaction of some sort. And that is very general information, and I'm going to show you how it adapts to M&A specifically. Just how there's a specific buy and sell side that adapts to M&A specifically. Things can change and twist a little bit when we look at specific sectors of investment banking. So due diligence, again, in the context of M&A, is the in-depth analysis of a target firm to gain an accurate understanding of the firm and have an unbiased estimate of the value of that firm. And it's kind of what I said, right? The financial transaction is M&A, and the details that you're analyzing are the value of the target firm. So it's great to know that general definition so you can adapt it to everything, really. This includes gauging the strengths and weaknesses of a firm and determining the financial condition of a firm. Guys, name me a financial report right now, and if you name me a financial statement, I'm going to be very sad.
A financial report?
Financial report. This is some key information to recall. That is a financial statement. I am very sad. No, it's okay. Financial report though. Remember, financial statements can be found within financial reports. So what are some of those financial reports that we can find on EDGAR, the SEC's filing database? The prospectus is one of them, which includes the recommendation. Well, that's the research report. The research report includes a recommendation. What about the 10K and the 10Q? You guys remember those? Oh, you did? Okay, sorry, I couldn't hear you. You need to speak louder. But 10K, remember, that's that yearly report produced by a company analyzing or telling its financial details. 10Q every quarter. How many quarters are there in a year? 4. AKA every 3 months a company needs to release a 10Q. At least if it's public, it needs to release it to EDGAR. And we all hopefully know what a public company is by now. So in essence, due diligence determines whether or not a deal is advantageous to the buyer. Will the buyer incrementally increase in value, aka is this really synergetic, right? And whether the deal is a fair price. They do this using financial modeling, using pro forma financial statements, right? What does that mean? Well, pro forma financial statements are projected financial statements, so a projected balance sheet, a projected income statement, a projected statement of cash flows. And notice how it's pro forma. Well, what does pro forma sound like? Perform, right? So how's this company performing in the future? That's why they call it pro forma. It's so genius, right? It's like calling investment banking club the best club in the universe. Like, I mean, it's like, it's right neck and neck, right? Just like that, so it makes sense. So projected financial statements, income sale, I already talked about that. These projections are used as inputs in the valuation process. Valuation is one part of DCF. A DCF is a financial model. DCF stands for discounted cash flow analysis. You see how everything just tumbles down a rabbit hole? And we're gonna talk about DCFs in a second.
Okay, well, if I get this mic to work, we'll talk about valuing a company. So the primary goal of due diligence, as I just described, is to value a company, right? So due diligence is doing your research on that company, right? So once you do that research, what's the goal of that research? To value that company, to see if you want to invest, Ivan, stop taking photos. So there's like 2 important valuation methods. First is the discounted cash flow method. Basically, it's a projection of how much money a company will make in the future. But the reason why it's called discounted cash flow is because it accounts for things like inflation and how like money now is worth more than money worth in the future, which is why it's discounted. Then we have accretion/dilution per shares. I think that's how you say it. It determines whether the earnings per share will either increase or decrease. So the earnings per share is per share of a company, how much does that share earn, right? So if you have a high earnings per share, that's obviously good, because if you own some stock, there's a high earning per that share, you're earning a lot of money. But if it's very low, or after a merger or after an acquisition, it decreases, that's probably not the best investment because your money is making less / is less profitable.
Thank you.
Of course.
Guys, do tech stocks usually have high earnings per shares?
No.
Exactly, right? They're what we consider value stocks for the most part. AKA, they put a huge premium on their stock and they suck. No, I'm just kidding. Some tech stocks are good. But Tesla's not doing too good right now, right? It's not doing too good right now. I honestly think Elon Musk is trying to do too many things at once. Like Neuralink, SpaceX, Tesla, Boring Company. How many other things can you do? You know he started drinking Yeah. You know he started drinking ketamine? I like recently saw that. I was like, that was really interesting. He like smoked a joint too, so I don't know what's going on with this guy. Yeah, how do his shareholders feel? That's the question. How does his board of management feel? Those are the questions that you have to ask yourself as someone working in high finance. Negotiating the terms of the deal with the target firm. So investment banks are, in some way, at least, let's say you're on the sell side. You're selling that company. In the context of M&A, you're selling that company. Well, you want to make sure that you can get as high of a price as possible. So that's going to be your negotiation. Likewise, on the other end, if you're an investment bank advising the company that's buying another company, you're going to want to make sure that the price is pushed down as much as possible. So regardless, you're going to be negotiating as an investment banker, as an advisor of these companies. So you're also going to be negotiating the terms of the acquisition. So who's going to be on the board of directors, who's going to be on the management team, necessary employment contracts, and so on. And due to excess negotiation, the final M&A deal is usually substantially different from the one that was initially proposed. Good investment banks, however, will usually know when to stop negotiating, and we'll get to why in a second. In a client's order to complete a deal, they may try and win at any cost. And we'll get to the winner's curse. We'll talk about that in detail. But usually you don't want to try and complete a deal at any cost because desperation will usually lead to a few minute errors somewhere.
Alright, complete the deal. So at the end of the day, obviously, the deal's got to come to an end. Something's got to happen, right? So both the acquirer and the acquiree's board of directors must meet to approve the deal. So, obviously, both companies have to agree to the deals, to the terms. So comes into the fairness opinion. So when the buy and sell side advisory investments making firms tell their clients that the deal was fair and no entity was over or underpaid. So like, if you've ever been to Costco, at the Costco line at the checkout, the person has to take your receipt to make sure you didn't get overpay or underpay for any of your items. That's just the Costco saying that their fairness opinion, to make sure no one got scammed, them or you, right? The shareholders look at this opinion as a third-party opinion and as approval that the transaction was fair, right? So make sure everyone got a good deal on it that they agreed to. Deal closing. In order for the deal to actually close, the shareholders of both parties must approve the transaction. Just, they gotta both approve it.
Exactly. Thank you, Nicholas. And guys, in what situation will the shareholders of both parties technically not, but technically do approve? In what kind of merger situation? Hostile takeovers. There we go. Do you guys remember me joking about Pac-Man, the Pac-Man defense? That was funny, right? Can someone tell me what company has actually underwent that? Because that's crazy. I need to actually look at that. That's me? Come on, Reed.
The Bendix Corporation.
Bendix Corporation. Okay, interesting.
It's
You want me to do it?
I encourage no one to
So, the roles of the sell side M&A advisor is readying the company for sale. This could be giving them some consulting advice or whatever they need to get ready, and marketing the firm. So they'll do a bunch of research to make the company look appealing and get it ready to be sold.
I'll talk to you about that later in private.
There's an issue.
Readying the company for sale. So some companies are looking to be acquired. So remember, right now we're talking about the sell side M&A advisor, aka the investment bank that's helping the company prepare itself for sale to another company. So in this case, sell side investment bankers will prepare two things. Steps to make the target firm more attractive, aka what steps can we take that for a general acquisition profile will make this thing attractive. So what are some things in an acquisition profile for all companies that are pretty attractive? Do any of you guys remember? I mentioned them briefly. What's up? Lots of money. Okay, that's one. What's up? Revenue. That's kind of corresponds. What about not a lot of debt? There we go. Another one. Unused. So what in an acquisition profile is something general that can be applied to most companies that makes it really attractive? So we
Makes a lot of money.
makes a lot of money, not a lot of debt, unused tax credits, things like that, possible for great synergies, and it really goes on, right? But that lots of debt capacity and unused tax credits, those are important. So make sure you remember those. And they're also going to help prepare an analysis of the company, which is of course important. Investment banks are responsible for advising and due diligence, so they have to analyze the company, right? Investment bankers will develop a valuation report for the company and find reasonable values at which it can sell for. This analysis will provide information regarding selling certain business lines of the company as well, instead of the entire company. Guys, that's important. Sometimes a specific business, M&A doesn't just happen with company to company. It can happen with a fragment of a company. A fragment of a company can be sold to another big company because they don't want to organically grow some kind of product line. So that's kind of key to note here. And sometimes that small product line can sell more for the entire company as a whole just because of how valuable it is. And you're kind of making that diamond in the rough shiny. Exactly. That was a good song, right? That was lit. All right. at any time, or I mean at times, the sale of part of a company will make more than the sale of the company as a whole, like we talked about. But some companies are not looking to be acquired, and that's where investment bankers will help develop that killer B team, that team of lawyers, of investment bankers, of tax specialists, and so on. All right, Reed talked all about that last meeting, and they're going to help prepare shark repellents. So again, what are some shark repellents that we know? What are, Pac-Man. Okay, that's a good one. Pac-Man. Golden parachutes. There we go. Do you remember what golden parachutes are for? We're going to talk about it in a second with misplaced incentives. Exactly. So golden parachutes are compensation packages guaranteed to executives in the case of a merger or an acquisition, or at least outlines what exactly will happen to them, right? We have poison puts, we have poison pills, we have so many, right? So just take a look at those. They're kind of important.
So, sell-side investment banks advisors primarily focus on marketing the firm. So this is just them making it more attractive so that maybe that it'll be acquired easier. So they do this in two ways. They prepare all the detailed marketing materials for the buyers so they don't have to do that themselves. And they connect the acquiring firm and the target firm together, obviously so that company doesn't have to do it themselves as well. So, the reasons that an M&A deal may go wrong: faulty analysis. So, little analyst Jimmy might have messed up some numbers along the way, and that it could possibly go wrong. Misplaced incentives. Once again, something went wrong along the way. Overpaying. Culture wars. That's like the Wolf of Wall Street. And overstated synergies. So yeah, this is mainly.
These are many of the reasons why an M&A deal may go wrong. Yeah, good job.
Yeah, I was saying little Jimmy might have messed up some numbers.
Yeah, Jimmy might have messed up some numbers.
And he's about to get fired.
Exactly. He probably did some insider trading too. You can't ever trust Jimmys. You know what I don't get? If Nancy Pelosi can buy stocks, knowing that she and the government as a whole dictate markets, why can't sports players bet on their own games?
Hell yeah.
They can?
Just not legally.
Just now?
No, just not legally.
Oh, just not legally? Yeah, exactly. But like legally, people literally working within the Federal Reserve can buy up stocks, probably knowing information about companies prior to it. Because let's be honest, Nancy Pelosi shouldn't be making net millions of dollars every single trade. Like that does not make sense. Yeah, I'm going to explain it in a second. Misplaced incentives. There we go. Speak of the devil.
Wow.
So some M&A deals shouldn't happen in the first place because the incentives for that M&A deal are terrible. They're incorrect. Ideally, you'd be incentivized to pursue an M&A deal because of, tremendous shareholder value increases due to things like synergy. But right here, this M&A deal might be happening because of certain compensation packages that might be forwarded to, management. Board of directors might be sniffing a little bit of money. Who knows? But many people getting paid is one of them. The empire of the management to oversee getting larger. At times, M&A deals may even fail to go through because the firm's boards and management teams are so concerned with their positions. And that's where golden parachutes come into play. That helps guarantee your position in the case of some kind of merger or acquisition so that, we don't have to worry too much about our individual positions. We can worry about the company's profitability and welfare as a whole. They might fight possible acquirers when it is the best interest of the shareholders to actually get acquired. That's why management should have a large stake within their own company so that they're making decisions in line with that which is best for the company and the shareholders. Overstated synergies. Take it away, David.
Thank you, Ion. So many M&A deals fail because investment banking analysts are often too optimistic. So if you're optimistic, too confident something's gonna work. So oftentimes they think that these synergies are gonna be very successful, very profitable, but sometimes that doesn't always translate into reality. This means that these shareholders are sometimes disappointed because they expected a large return or a large profit, but in reality, it was not that high. So an example is the Quaker Oats acquisition of Snapple Beverage for $1.7 billion in 1994. That's just an example where they projected the acquisition to be extremely high, but in reality, that didn't happen.
Thank you.
Yep.
And in our interview with an investment banker next week, although it might not be an investment banker, I'm still confirming, I had 3 cancel on me, literally because they all had projects. So it's pretty crazy. They're really busy. They're working till like 3 a.m. every day. So we even had that investment banker come in one time, and he had to like get on his phone for 2 seconds to respond to an email from his MD. It's that tight. It's that serious. But when you're getting big money and when you get possible buy-side offers, then you got to do what you got to do, right? Huh? That's not the kind of life that you want. Well, I wouldn't want to be homeless too. I'm just kidding. What?
Who doesn't want to wake up 3 a.m. every day?
Okay, culture wars. Yeah, there we go.
Alright. Some different companies have different ways of doing things. You know what I'm saying? So that's what a corporate culture is. So an organization's belief and behaviors, which affects how the employees, management, and the customers interact with each other. At times, it's difficult for 2 firms to combine because they have different corporate cultures. Like if someone is one of them is hierarchically oriented, or if someone has more worker autonomy.
I have a funny story about this actually, right? So I know an investment banker personally that transferred investment banks after the acquisition of one of those banks. And previously, and both of them are bulge brackets, by the way. However, the first bulge bracket he worked at is a bit more prestigious. I'm not going to name them because, I'm scared something might happen. But that bank was a bit, no, I'm not going to tell you. That bank had a bit more worker autonomy, meaning the analysts could do their work, finish their PowerPoints, whatever that needed to be done, and send it straight to the MD. The next bank that he worked at was more hierarchically oriented, and he didn't really know that. And he never actually checked his analyst work because of that, but what they expected him to do was check the analyst work, then forward it on to the VP, and so on. Because of that, his bonus was kind of cut. And as we do know, in investment banking, your bonuses can be up to like 200%, right? So if your bonus is cut, that's kind of screwed. And because of bonuses it's because of bonuses that your total compensation can reach like 300K or 250K just as an associate, right? And as a VP, MD, millions. But honestly, exit after you're an analyst. Go into private equity, go into hedge funds, go into venture capital, go to a small business. Investment banking, or at least your analyst years, provide you with key information about the financial world. It's going to make you a financial behemoth. That's the only reason I teach it. Faulty analysis. It's rare to produce faulty analysis due to standard valuation methods being applied, improper standard evaluation methods being applied by investment banks in that due diligence process. However, a factor in the valuation process, like the DCF, being a little bit incorrect or a little bit up or down can pretty much change the result of the valuation entirely. And that's why, I'll get to the margin of safety in a second. But guys, when things are more complicated, we'll usually think that they're a bit better, that they're a bit more precise. A good analogy for that is when someone comes up and speaks and uses a lot of big words, a lot of really intellectual jargon, you may have the false assumption that they're smarter than they actually are, when in reality they could have opened a dictionary 5 seconds before and managed to cram those words in. Who knows? But we think that they're better because of things being a bit more complicated. That's the illusion of precision. And many people think that because these valuation methods are so complicated, they're always precise. But that's not true. So the margin of safety is, make sure that a few things can be tweaked in your analysis, like a DCF, for example, and you'll still get net profitability, a net better result for the company. So, let's say your synergies were a bit overstated, or for some reason the company didn't have as many tax credits as you thought they did, you still want it to be net profitable in your DCF. And some companies are so anxious to do deals that they accept it with no margin of safety. That's not a good thing. Don't do that. No, forecasting future cash flows can be very difficult. That's what a DCF did, right? That's what David talked about. He talked about how a DCF was projecting the value of a company in some way by looking at inflation and so on. But there are certain financial statements, like pro forma financial statements, that project the future value of a company. And that's difficult, right? You're predicting the future. There are a lot of factors you need to consider. And that's why investment banks can have varied analysis. You can come on to different results. And I believe this is last. I'm pretty sure this is last, so make sure you pay attention, all right? The last is always the best. Save the best for last. There we go. So like bidding for an item that someone really wants at an auction, remember we talked about those bid wars, corporate executives may see themselves paying higher amounts in bidding wars that they initially intended on paying. And that's the winner's curse, right? The winner at an auction is usually the person that is lost because they paid the most, or at least they're usually the person that has overstated the value of the actual object they're buying because they've paid the most for it. No one else wants it that much. So what's that relevance? Well, that's really great in an acquisition when there's a bid war or something for the shareholders, but it's not so great for the shareholders of the buying firm. So it's great for the shareholders of the firm that's being sold, that's being acquired, because they're getting a tidy premium on each stock. But for the shareholders of the company that's buying or that's acquiring that firm, well, your company is paying more to acquire that firm, and that overall may not be super profitable for you. Could decrease share value temporarily, so on. That's why it's important to be long-term shareholders, all right? We want to stay in for the long run. We need to stay in for the long run. We need to promote going private transactions like Dell did so that you can, remake your financials or whatever you need to do so you can be profitable again. Again, this is the link tree. Guys, a lot of you guys are here. I don't know if you're all on the Remind. I post very regularly on the Remind, so make sure you join that if you haven't already. Instagram, of course. Make sure to like all of the reels, comment on them, subscribe, share, whatever you guys want to do. And YouTube videos, of course, so on.
What's your opinion on Credit
You just said so long.
Credit Suisse? Well, it got acquired, so it's a major L, right?
From
By like HSBC?
HSBC?